Welcome to the New York Stock Exchange, the symbolic heart of American free market capitalism. Now, it may not look like it, but the floor is actually a much less active place than it used to be. That's due to the rise of electronic trading. But still, the return of confidence, the return of activity is palpable. America is back after the crisis, and Wall Street is back on top. You can see that in the value of the stock market. Let's compare that to the rest of the world's developed markets. You can see that the US has been outperforming ever since the crisis. You can also look at the value of stock markets. There was a brief period in 2007 before the crisis when Europe actually had a bigger stock market by market cap than the US. Absolutely, totally in reverse. And then, of course, there is the dollar. It appeared to be in a permanent decline. Now it seems to be in an almost unarrestable rise.
The dollar is strong, partly because of good things happening in the United States. When the crisis first hit, the U.S. pursued very aggressive monetary policy, very aggressive fiscal policy. Other countries didn't do so. And so the U.S., because of the synchronized downturn, the U.S. policy response put us in the lead on the outcome. However, it's not just good things in the U.S., but it's that Europe and Japan are also reeling still. They have not found a new growth path. The Bank of Japan announced a very large monetary stimulus, surprising the market at the end of October. The ECB has made it clear they want to do more stimulus, while the Federal Reserve is talking about raising rates sometime towards the middle of next year.
Then there's the bond market. Yields on treasuries haven't been this much higher than yields on German bunds in 15 years. That shows much greater confidence about the American economy. We'll take a look at manufacturing surveys. Remember, these are fixed so that above 50 is expansion, below is recession. Very clear again, the US is leading the world out of recession. Everybody else is in trouble still. But there remains one big question. Can this possibly last? Americans are angry about their economy. You can tell that from their election. There's no great sense of growth on Main Street. How can stocks possibly be at these kinds of all-time highs?
A couple of things going on here. I think if you look around the world, it's very hard to find too many economies around the world that are getting better. Their absolute growth rates may well be higher, but they're not getting better. Whereas the United States, the absolute growth rate is quite low, but in many aspects, the economy is actually improving. And I think that's one of the reasons why the U.S. stock market is so outpaced some of the foreign markets.
I think principally the main drivers for the bull market have been and continue to be strong earnings and good growth in earnings, interest rates being extraordinarily low, and a significant amount of liquidity. And that money has got to be invested somewhere. To use the expression, the music is playing and you have to dance. So what choice do you have when earnings are good, interest rates are low, and you're forced into taking action if you're a professional investor, and most of this market is driven by professional investors.
Now, there are more problems. The US stock market does not look cheap, and the rest of the world does.
So the PE ratio on a Shiller 10-year smoothed basis is currently 27 times earnings. That's expensive. That's about where it was at the end of 2007. Does that mean it can't go higher? Of course it doesn't mean that. Shiller PE ratio is almost useless in telling us where the market's going in the next year. But it is breathtakingly powerful in telling us what kinds of returns to expect on a 5 to 10 year basis. And the Shiller PE ratio is telling us don't expect much return over the next 5 to 10 years. I mean, if you look at EFA, for example, MSCI EFA has a Shiller PE ratio of just over 15 times earnings versus 27. It's half off. Emerging markets, 15 times earnings. It's half off. Now, for EFA, unlike the US has anemic growth. EFA has growth that is roughly zilch. And so, of course, it should have a lower multiple. But I'll take growth that is roughly zero at a 15 multiple over anemic growth at a 27 multiple. It's a better deal.
Then, as ever with the stock market, there's the question of profits. They've been rising healthily, but they've been boosted by stock buybacks, which many people feel may be unsustainable. And they've also been helped by historically very high profit margins. Can they be sustained?
The problem with earnings is that the bottom line is benefiting from the cost cutting. The top line has not been growing. Sales revenues have not been growing as much and as robustly as you would like to see it do. And that eventually has to resolve itself more favorably. You cannot continue to cut in the middle, have the bottom line grow. I don't think that bottom line growth is going to be enough over time.
Then there's the issue of interest rates. Higher rates tend to mean lower multiples on stocks. QE bond purchases have just ended and they certainly seemed to support the stock market. Now, for years people have worried about what would happen when QE ended, but now people seem much more comfortable that higher rates might actually be good for the stock market.
Normally, under normal circumstances, why would long-term rates go up? Long-term rates go up because the nominal economy is getting stronger. And if the nominal economy is getting stronger, yes, interest rates will go up. But remember, profits are nominal. So the higher you think rates are the higher one thinks rates are going up, the more one has to be bullish on corporate profits and the growth in the nominal economy.
But perhaps the biggest reason for worry is that nobody seems to be worried. That's always a concern.
I'm just finishing up a huge business trip that took me throughout the US, took me in Europe, took me throughout Asia. And I haven't met a single person, a single money manager who's not bullish on the dollar, not bullish on US stocks, not bullish on this divergent story. And so I think that what can go wrong is not going to be that Europe picks up or Japan picks up, but that the shine comes off the US side of the story.
Explorer, this is Houston.
Go ahead, Houston.
Mission abort. Repeat, mission abort.
Explorer, this is Kowalski confirming visual contact with debris. Debris is from a BSE sat. Repeat. I have
Dr. Stone requesting faster transport.
We have to go, go,
Kennedy reports meteorological.
One of the things that I borrow from art imitating life, is the movie Gravity, where everything seems to be strongly under control, science is at its peak, the astronauts are in outer space, and then something unexpected happened. I think that that movie is kind of the way that things might happen, and that's the thing that I would be extremely concerned about. An exogenous event with a chain reaction that is unexpected, initially dismissed, and then that leads to a significant whole other chain reaction that could impact the global economy and the markets.
So yes, wintry weather could well return to Wall Street. What people are betting at present is that the Fed will seamlessly move towards higher interest rates without causing a disruption, that American companies will manage to keep cranking out high profits without seeing their margins tighten again, and that the US economy can keep humming along reasonably well even if the rest of the world remains stone cold. And that does sound like quite a big ask. For the time being, everything is moving in America's direction. Wall Street is back. This could carry on a lot longer.